All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about maybe some timely news, some things that are going on in the news. So, we're going to talk about some of the AI power plays. There's some deals going on with OpenAI. They're partnering with companies like AMD, Nvidia, as well as Oracle. And so we thought maybe we would touch on some of those. Let's start with how this capex super cycle is starting to make its way and how AI could be driving a lot of this. So do you have any, I guess, initial thoughts on some of this?
There's big numbers getting thrown around.
Very big numbers, right?
Yeah.
Hundreds of billions of dollars being tossed around. I think the one that is interesting to me is the Oracle deal that certainly got a lot of hype. And I think they were offering a $400 billion deal between OpenAI and Oracle. And Oracle stock jumped huge on the news of this. And on the surface, it looks really interesting and it could be awesome. But I think if you dig a little deeper, it may not be as appealing.
The first concern would be I've heard that people say OpenAI is not profitable yet. So if we're talking about $400 billion, the first concern that pops in my head, how is OpenAI going to pay for it?
Mm-hmm. Yeah, for sure. That's a big promise to make. And Oracle is going to be banking on that revenue to help sustain them and pay for the investments they're going to have to make. I've read some articles from Ben Thompson, who writes for Stratechery. He's probably one of the leading tech guys out there. That some of the projections for OpenAI's revenue for 2025 is around 12 to 13 billion dollars, which is nothing to sneeze at, but it's certainly not in the Amazon, Apple, Google, Walmart realm of 3, 4, $500 billion. So I guess that's one of my concerns is are they going to be able to scale to that point where they can pay Oracle that much money?
Let's say it's CapEx, which I don't know the specifics of if it is or not. But if we talk about like a Walmart or an Amazon that has 500 billion in sales, they're not doing 500 billion in CapEx. Tell me how you get from 12, 13 billion in sales. We're not even talking about the costs for OpenAI to run their business.
Mhm.
13 billion in sales to 500 billion. I mean, I understand it's spread out over multi years, but it just sounds very optimistic on OpenAI's part to assume that, yeah, we're going to have all the financial resources to be able to make a deal like this.
Yeah, it certainly does. If you listen to the talking heads on the markets that OpenAI or AI in general is taking over the world, and while it does have a lot of benefits and it is helping people, I think the scale part of it, I don't think we're there yet, and I don't think we're going to be there yet. And one of the big concerns I have, to your point about what Oracle is in particular, is that to receive that amount of money, they're going to have to invest on their end because what they're trying to do is provide infrastructure for OpenAI because they feel like OpenAI feels like they have demand that they need to meet and they're being constrained because they don't have the capacity to do what they want to do, which is why they're going around trying to make these deals with all these businesses, which okay, I get, but the hard part for us as investors is that OpenAI is not a public company. They're a private business. And so we don't have insight into that demand. We don't have people talking to the business, analysts or other people talking to the business, telling us what the demand is. We don't have a financial statement. We don't have a 10Q. We don't have a even an 8K to say, hey, this is what's going on. So it's a bit of a black box, right? And so we have to depend on Sam Altman and his being above board and honest about that. I'm not saying he isn't or is, but we have to put a lot of faith in that what he's projecting to these companies is in fact true. And the part that I worry about, especially if you're going to think about investing in Oracle as a potential play on this AI demand that is apparently skyrocketing. Again, not saying it's not, but the concern is that to Andrew's point, they're going to have to spend a lot of money. I don't have exact numbers here, but I know they're going to have to spend a lot of money to build out this infrastructure to be able to achieve the targets that OpenAI is setting for itself. And so the concern as a potential investor in Oracle is what kind of return am I going to get on that money? Just like if we plunk down our money to buy Oracle, we're worried about what kind of return are we going to get on that investment. The Oracle people running it, Larry Ellison and everyone else, I would think that they would be very concerned about how much money are we going to get? Like, what kind of return are we going to get on this 300 or 400 billion that we could receive from OpenAI? And if you dig a little deeper, you'll notice that Oracle doesn't generate a ton of free cash flow at the moment. Their revenue is not awesome. They don't have the financial wherewithal to build out the capex based on their current position in the market. And so to do that, to fund that, they're going to have to do things like take on more debt, or they might have to dilute their company, sell shares on the open market. Those are two of the three main options they have. And as an investor in Oracle, how much are you willing to bet that AI, that not only can they build out the infrastructure in a timely enough manner that it helps OpenAI not be restrained if they are indeed restrained, and how quickly can they do that, and how quickly can they recoup their money? Now, I read earlier today that this deal doesn't start till 2027, so they have roughly a year and a half to start building out the infrastructure to do all this for OpenAI. So that's one of my, I guess, bigger concerns as an investor, and that's something that you probably aren't hearing in the news, or at least if you just read the headlines and go, wow, this company's revenue projection growth grew by 359%. That's pretty awesome, right? But what is the reality under the hood, and how do you need to think about this going forward? Those are all questions that I'm asking myself.
I'm asking, like, hey, is there anything going on in the next few months where certain parties would be benefited by seeing big investment numbers? I saw on my calendar and my Google calendar, there's an election day next month. So
Oh,
I don't know if this is all
yeah,
related or not, but
yeah, it could be. Yeah, very true. Yeah, that's a very good, that's a very good catch. How do you think that could impact what we're talking about right now? You think it'd be a plus or a minus if you had to
I
guess?
think I think it's pretty clear. We came into this conversation. I came into this conversation pretty minus on this whole thing.
Mm,
I'm I feel like history has been unfairly treated by investors and the stock market and Wall Street because you have so many people who want to look at the history of charts. Oh, the stock market did this in 2001 and we're in the exact same thing, and
right.
that's never the case. However, that doesn't mean we can't learn from history. And if the four most important words in investing, or the four most dangerous words in investing, are this time it's different, if you look back at previous technologies, big technological booms like the dot com bubble, and I'm sure this is such a tired topic, but just hear me out for a second. In the dot com bubble, there were also lots of big numbers being thrown around and a lot of ordering. And in fact, the ordering, all this backlog, which what Oracle is talking about is backlog, like to Dave's point, it's 2027. What ended up happening in 1999, 2000 is the infrastructure tech companies ended up overestimating how much capacity they would need. And so the entire industry was double ordering, triple ordering because everything was in shortage. And so because they all overestimated all of the backlog that investors were betting on, a lot of that ended up not materializing. And so you had not just a pop from the valuations. Obviously, a lot of these stocks were expensive, but you also saw the way they were pricing the stocks come down because investors were pricing it based on what the backlog was rather than what's actually been booked. And so if we see that kind of a situation in AI where to your point, Sam Altman or any one of the big thought leaders is overestimating demand, then what does that do to the backlog and how much of that does get converted to revenues? Because in normal times, in like a mature tech company like a Cisco or something like that, you see their backlog and that pretty reliably turns into revenue. You see the remaining performance obligations for Google Cloud, and a lot of that turns into revenue. Maybe not even a lot, maybe all, right? In normal times, backlog equals revenue. But if we are in a situation, and I don't know because I'm not close enough to the company people who are making these projections, if it is overinflated, if it is overly optimistic, then it's going to be really, to your point, painful for investors who are betting on these big headline deals. AMD, I think, being another one that investors are getting really excited about. So I would I look at backlog and I look at those investment numbers and I have a heavy shade of skepticism because I've seen what happened. You know, I've studied. I wasn't aware of it. I'm too young to have been like an investor at that time, but I've studied it and I know that backlog doesn't always equal revenue when things get overly optimistic.
Those are all great points, and it reminds me of what Charlie Munger preached all those years about incentives. Again, I'm not casting aspersions on somebody like a Sam Altman, but there is definitely an incentive for him to prognosticate or to predict that these big numbers are going to come to pass. And what does he stand to benefit, or how does he stand to benefit from this idea? And he stands to benefit from the ability of other people to give him the platform to do what he wants to do or what he hopes the company can do in the future, and without having to pay for it himself. And that is, I mean, for him, it's a pretty sweet deal, right? And it could be an amazing deal for them. We could be looking at the next, you know, air quote next whatever kind of company and whatnot. But history is littered with the hopes and dreams of investors and companies that didn't pan out exactly the way it did. This could end well, where the company, where OpenAI does good and maybe doesn't do, you know, Amazon level numbers at this point, and it could still do okay. But the hype is the thing that scares me, is that the projections are, to Andrew's point about the 2000 bubble, if you will, is that everybody thought that it was going to change. And they were right. They were just early, like a lot early.
Mhm.
And that's one of my concerns about this. Maybe we could talk about this and think about this and how these ideas could impact some of the companies that we do own, somebody like a Microsoft or a Google or some of the big cloud players, how some of this CapEx spend and the impact of AI could impact them.
Sure. Yeah. Well, maybe break down the three cloud hyperscalers. Explain like I'm 5 years old if you're not somebody who invests or has even looked at those stocks. What are those businesses? How do they make money? And why is it a good place to be?
Okay. Yeah. So the I guess the three main ones that most people think about would be Microsoft with Azure, Google with their Google Cloud, and AWS for Amazon. And those are the three main hyperscalers. And these are the largest cloud platforms that allow other businesses to operate their businesses on these platforms. A good example of that would be Netflix, which uses AWS to power their platform. So a Netflix business doesn't really operate very well or nearly as well without AWS. And so these companies, in particular Amazon, Google, and Microsoft, make a in some varying cases, they make a large or a very large portion of their revenues and profits from these cloud businesses that are all built on data centers that have these chips in them, that GPUs in particular, or other chips that the companies themselves are making, that allow these businesses to operate. And so they're basically the platforms, I guess the easiest way to describe it, for a 5-year-old is they're the platforms that allow other businesses to operate on.
Yeah, like you go on Netflix.com, you're not able to view that in LA or in New York or in Texas or on your phone or on your iPad unless there are data centers powering that. In the old model, companies had to have their own data centers that were on, IBM had IBM servers on their campuses. Now, to your point, these disruptors, the AWS, the Azure, the Google Cloud, they host the data centers and then they use their economies of scale to allow Netflix and Facebook and whoever else to rent space. So in IBM's case back in the day, they had to buy these expensive servers. Only IBM could make use of that. So there are bound to be inefficiencies. But if you're a AWS or you're a Google Cloud, you're able to rent it to multiple people. Those servers are always running, always being efficient because people are using that capacity. So it's definitely been one of the huge innovations of the past 10 years. And those numbers, if you look at their revenues and their profits, they're all profitable now. Those are real numbers. And that's
Yeah.
real growth that's happening. That has happened already.
Yes. Yeah, very much so, and they've been growing very, very quickly. And it's the infrastructure to build out the cloud systems has been ongoing for a while, but the revenue explosion for these platforms has been more recent. I would say in the last 8 to 10 years, it's been more recent, and companies like AWS for Amazon and Azure for Microsoft were the early leaders, and now Google has stepped into the arena, and they have certainly upped their game quite a bit, and they've improved a lot. They're still behind the other two, but they're closing the gap quicker, and it's impressive to see the build out of these platforms and how well they've been adapted and how well they work. It all happens behind the scenes and it's very seamless, and it is an amazing thing to think about. So to get there though, they've had to spend a buck or two, and I guess what are your thoughts on the capex that they've spent, and maybe how the companies funded that, and also how the returns on those investments have been so far and probably will be going forward.
Yeah, to your point, it has been a very expensive build out. The returns on the cloud have reduced the ROIC for both Microsoft and for Google. In the past, Microsoft and Google had very high ROICs. We're talking about like software company type ROICs, 35, 40% in that range. And since they've really been aggressive in these cloud build outs, the ROICs have dropped down to the 20-ish. Now, you can look at that in a couple ways. You can say, all right, this is inefficient spend because it's reducing ROIC, in which case I would say that's a fair statement. And if you're not bullish about cloud computing, then certainly if a lot of the demand for cloud computing is driven by AI and that is something that's being overblown, then sure, you would expect that to become a worse situation down the line, especially if you see the bubble quote unquote pop. Another way to look at it, however, is Microsoft and Google, owned by Alphabet, they have core businesses and they have these cloud computing businesses. So they're two very different businesses with different business models, which makes for different financials. Software is very high margin, and sometimes that can lead to a higher ROIC if they're especially if they're growing organically and not growing through acquisition. Google, similar story. They have the advertising unit, and that has generally higher margins than Google Cloud. So you can ask yourself, is it just a higher growth rate on a business that doesn't have as high of ROIC? That's another question you can ask yourself. And then the last thing would be, if ROIC continues declining, then yeah, maybe you start to become worried, especially if ROIC is not earning higher than the cost of capital. But is an ROIC of 20% still acceptable to you as an investor? I don't know what your benchmarks are for ROIC, but for me, You know, a 15% ROIC, if you're reinvesting everything in the business and you're earning 15%, that's a good ROIC because you're growing 15% a year. That's a very rare feat for businesses to do. So going from 40 to 20 sounds really bad from an ROIC perspective. But coming from somebody who owns these businesses, I see the positive side, the optimistic side. And so I tend to think that that decline is not necessarily a bad thing and doesn't necessarily mean that these are inefficient spends, but I'm happy to be wrong and that's why I diversify.
Yeah, yeah, right. And that's that's exactly why we diversify because a lot of this is still unknown. And as they continue to build out for these continuing ongoing cloud plays, but not only that, but also the AI that they're competing against as well. There's been a lot of news about the ongoing spend for companies. We haven't touched on Meta, but they're certainly in the mix of spending a lot of money on capex for AI. And I know there's been some discussion about Microsoft and Google as well, and what their expectations are ongoing for the capex spend. And one of my concerns about it, while I'm very optimistic about the companies like Andrew is, one of my concerns is that I've read, and I haven't been able to verify if this is true or not, but I've read this from a few other sources that the investments in the GPUs, for example, from Nvidia might be air quote outdated sooner than we think. And so this could end up being a situation where companies are having to spend a lot of money to renew the cycle of their data centers or the chips in the data centers faster than maybe normally you might think of for investments like this. And you started to see some of this when companies are changing their depreciation schedules for how long their investments are depreciated. And when they start ratcheting it down instead of going up, that tells me that that means they know that they're going to have to continue this cycle. And that's one of the things that does concern me a little bit about what's going on with more related to AI than necessarily cloud businesses, but it's all kind of intermingled. And one of my concerns is if this is an ongoing, if Microsoft are we going to have to, I guess, what's the word I'm looking for, model Microsoft spending 80 billion in capex every single year, as opposed to what we've seen with Amazon, for example. It's not related, but it kind of is, where they would spend a whole lot of money to build out their infrastructure, i.e., their warehouses or the vehicles that they use to transport all the goods you order from Amazon Prime, for example. They spend a lot of money in that infrastructure, but it was a big upfront cost, and then they can benefit from that for hopefully many years before they have to spend big on that cycle again. And I guess the question I'm asking myself is, as I invest in Microsoft and Google and continue to be very bullish on the businesses, do I also have to expect maybe lower margins that I've seen in the past? And is that just going to be an ongoing part of the investment in Google, is a lower ROIC? But to Andrew's point, 15, 20, 25% ROIC is nothing to sneeze at. And if those companies can continue to invest at that high level of rate, it far outseeds their cost of capital, then I'm more than happy to continue to keep funding that bet. So, but it is something I just have thought about and want to try to keep in the forefront of my mind, is how is this CapEx spend cycle going to continue? And is this the new air quote normal?
That's a very, very, very good point. I would bet if I was a betting man that the valuation multiple probably compresses if this capex ends up being, to your point, maintenance capex rather than growth capex. But making bets on valuation is about as silly as betting on what the weather will be in 3 months.
Or the Jets winning a game? Sorry. Fantasy football backlash there. As we start to see these announcements of these big deals, who do you think, are there other places that maybe people could look for potential other beneficiaries of this?
If this build out continues,
Yeah.
yeah, semiconductors, obvious one. Yeah. Do you see pockets in
Yeah.
there that would be more interesting if this continues?
Yeah, it could be. Some of the things that I've been thinking about are more of the not necessarily directly the obviously the foundry like a TSMC is going to benefit from this, but I also think the companies that are associated with that are along the food chain, if you will. So a company like, I'm not saying these particular, but just ideas, ASML, maybe Applied Materials, maybe KLAC or KLA, Lam Research. Some of these businesses might be beneficiaries of this kind of increased spend. And so those are companies that I'm taking a look at, and maybe there'll be something that shows up in Value Spotlight someday.
Cool, cool. Yeah, I mean, I think it's no question that human innovation is going to continue. There's going to be rough patches along the way. My big gripe is how much of the AI is sustainable or not. Just kind of turn it around on yourself, all right? If you've looked into AI, how much AI have you looked into and tried out versus how much AI have you continued to use? Maybe for me as a small business owner, I experiment with AI more than other people might. But I just wonder again, the whole projecting everything to go up and to the right with no pullbacks along the way just seems really optimistic in that if you have a new technology, people are going to be checking it out. And so if you have a huge boom from people checking it out, are the same people who are using AI going to continue to use the same levels of AI over the next several years? I think it's just a very optimistic way to look at it.
Yeah, I would agree with that, and it really appears that they're all leapfrogging each other. Like the in particular the models that you hear people talk about, ChatGPT is hot right now, and then Grok becomes a hot thing for a minute or two, and then DeepSeek from China becomes a thing for a minute or two, and they just keep seeming to leapfrog over each other. I'm going to date myself. I remember back in the internet days, my early experience with the internet was AOL, and that was the thing. And then I remember when Gmail and Google started becoming a thing, and I was like, wow, that's like I don't know if I can embrace that because I'm so used to using AOL, and I had been for a long time.
You still
So
have
it
it.
took me. I still have it.
Just kidding.
I still have it. It's an old email I still have, but uh, I used it as a search engine too because that was
Right.
one of the choices that you had available back then. And it didn't feel at the time like there was a lot of leapfrogging. Like there was Yahoo, there was AOL, and there were a few other ones that I'm going to blank on at the moment. But it didn't feel like there was the leapfrogging back and forth, back and forth. And so, to your point, it feels like there's certainly no clear winner at this point at all. And I also question how much, like you and I are business owners, small business owners, and so we play around with it and it can help us do certain things. But I have family members who don't touch it at all. And my wife doesn't touch it at all. And my daughter in law doesn't touch it at all. She works in nursing, she has almost no need for it. And so, to your point, for it to reach Amazon level revenues, I think it's going to have to start touching those people on a more regular basis. And I, I, I don't doubt that we'll get there someday, but whether it happens in the next few years, I guess I'm a little more hesitant to be bullish on that.
Well, that's the problem is Wall Street will price things, and the more optimistic Wall Street is, the sooner that timeline they expect, which
Yeah.
it can be a nice way to lose money in the stock market if you
Yes,
have the
very true.
wrong
Very
timeline.
true. Yeah. Yeah, for sure. I like we were talking about earlier. People talking about the internet back in the 90s weren't wrong. They just were really early. And if you listen to Wall Street, they were all, it was going to happen tomorrow. And it didn't. It did happen, but it didn't happen on their timeline, to your point. And that's where it could be dangerous.
That and then something I've grown to appreciate more lately, picking the winners in advance is super, super hard. If you looked, and I'm talking about just in these emerging growth industries. If you look back in 1999, Wall Street's favorite darling was Qualcomm. Go look at a chart between Qualcomm and Broadcom both big semiconductor names, and just see the divergence in performance. People don't know. If you are curious about the history of Amazon, there's some great books. I think the Everything Store is one. eBay was actually considered by Wall Street and everybody to be better than Amazon. People thought Amazon was not going to be the future of online shopping. People thought eBay was going to be the future of online shopping. Again, I would recommend looking at the charts. And then to your point about the whole Google search thing, people don't remember 13 or 12 different options, and Google ended up being the one. So it's interesting when you mention the different GPT, AI, blah, blah, blah. Who's going to be the winner? If you can call that, more power to you. But I would rather invest in things that are more stable and already have seen things get ironed out rather than just take these guesses where we think, oh, Wall Street knows the answer. They don't.
They don't. They do not. You only need to look as far as quantum computing to see this playing out in real time. There's a handful of businesses that people are all frothy about for quantum computing, and for those unfamiliar with what I'm talking about, it's a it's a different type of programming and computing. I will admit I know little to nothing about it, but what I do know is that there are a lot of not a lot. There are a few companies that people are very frothy about, and several in particular have been very boastful about they are going to be bigger than Google in 2 years. Kind of, just insane projections.
Yeah,
There is one person running one of the companies. I don't remember the name of the company, but he has been very upfront about the fact that they don't have revenue. They have nothing to sell, and they have no revenue, and people are assigning them a 20, 30, 40 billion dollar market cap
crazy.
based on the hopes and dreams that these companies will be able to fulfill their promise. And I'm not saying they won't or that they will, but the fact that the market is already pricing these companies as such, I think you just need to look at Wall Street with some skepticism sometimes, because people will get super excited about things that could happen but aren't there yet, and you need to be very careful where you put your money. And so I think we've illustrated the point that there is a lot of potential for a lot of these things, and these very smart people are going to spend a buttload of money to try to get us there, but trying to pick the winner and being anticipatory of those potential gains, just maybe be a little more cautious.
Yeah, very well said.
All right, folks. Well, with that, we will go ahead and wrap up our conversation for today. I hope you enjoyed our speculation and discussion on what's going on with AI and CapEx spends and reading beyond the headlines. And with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.